Understanding the Stock Market by Trading Journey with AVS. What is the stock market? The stock market is a place where people buy and sell shares of companies. A share or stock represents ownership in a company. When you buy a share, you become a shareholder, meaning you own a small part of that company. Why invest in the stock market? The stock market is a smart way to grow your money. When you invest in shares, you own a small part of a company. As the company grows, the value of your shares can rise, and some companies also pay you dividends as extra income. Unlike keeping money in savings or fixed deposits, the stock market can give higher returns and help you beat inflation. It also gives you flexibility because you can buy or sell your shares anytime. Risks of investing in the stock market. Investing in the stock market can be rewarding, but it also comes with risks. Prices often move up and down quickly, creating volatility that may lead to sudden losses. Poor company performance, economic changes, or global events can also affect stock values. Many investors lose money because of emotional decisions, like panic selling during market falls. Another risk is lack of diversification. If you put all your money in just a few stocks, your portfolio becomes more vulnerable. While the stock market can grow wealth, it's important to invest wisely, manage risks, and stay patient. How to invest in the stock market? To invest in the stock market, first open a demat and trading account. Set your financial goals, research good companies, and start small. Always diversify your investments, stay updated with market news, and focus on long-term growth with patience and discipline. Key stock market terms. To understand the stock market, you need to know some key terms. A stock or share means ownership in a company, while an IPO is when a company offers shares to the public for the first time. A bull market refers to rising prices, and a bear market means falling prices. Your portfolio is the collection of your investments, and some companies pay dividends as part of their profits. Market cap shows a company's size, and blue chip stocks are big, reliable firms. Finally, an index like Nifty, Sensex, or S&P 500 represents the performance of selected companies in the market. Different types of stocks. Stocks can be divided into different types based on size, style, and risk. Large cap stocks are big, stable companies, while mid cap and small cap stocks offer higher growth but with more risk. Growth stocks focus on rapid expansion, while value stocks are undervalued companies trading below their true worth. Some companies also issue dividend stocks, which provide regular income. On the risk side, blue chip stocks are safe and reliable, whereas penny stocks are very cheap but highly risky. Choosing the right mix depends on your goals and risk appetite. Investment strategies. Investment strategies are plans that guide how you grow your money based on your goals and risk tolerance. Some prefer long-term investing, holding quality stocks or index funds for years to build wealth. Others choose short-term trading, taking advantage of quick price movements. A balanced approach includes diversification, spreading money across different sectors and assets to reduce risk. Popular strategies include value investing, buying undervalued stocks, growth investing, focusing on fast-growing companies, and dividend investing, earning steady income. The key is to pick a strategy that matches your financial goals and stay disciplined. Building your smart portfolio. A smart portfolio is all about balancing growth, safety, and diversification. Start by setting your financial goals and risk level. Mix large cap stocks for stability, mid-small caps for growth, and some dividend stocks for regular income. Always diversify across sectors, tech, banking, pharma, energy, so that one weak area doesn't hurt your overall returns. Add safer options like index funds or ETFs for steady growth. Review your portfolio regularly and adjust as markets and your goals change. Remember, a smart portfolio is not about chasing quick profits, but about long-term wealth creation with managed risk. Prepare your future. Your future depends on the choices you make today. By saving and investing wisely, you build a strong financial foundation that supports your dreams. Planning early, diversifying investments, and staying disciplined will help you secure long-term wealth and stability. Preparing your future isn't about luck, it's about making smart decisions now that give you freedom and confidence tomorrow. Invest in valuable stuff. Investing in valuable stuff means putting your money into assets that grow over time and secure your future. Instead of spending on things that lose value quickly, focus on stocks, mutual funds, real estate, gold, or even skills and education that increase your earning power. Valuable investments not only build wealth but also give you financial security and peace of mind. The smarter your choices today, the stronger your tomorrow will be. The basic concepts. The basic concepts of investing start with understanding how money can grow over time. Key ideas include risk and return, where higher returns usually come with higher risk. Diversification, which means spreading investments to reduce losses. And compounding, the power of reinvesting profits to build wealth faster. Knowing these basics helps you make smarter decisions, avoid mistakes, and create a strong foundation for long-term financial success. Market participants. Market participants are the different players who buy and sell in the stock market. They include retail investors, individuals like you and me, institutional investors, mutual funds, insurance companies, pension funds, and foreign investors who bring global capital. Other key participants are brokers who facilitate trades and regulators like SEBI who ensure fair and transparent practices. Each participant plays a role in keeping the market active, liquid, and efficiency. Major stock exchanges. Major stock exchanges are platforms where stocks are bought and sold, providing liquidity and transparency to investors. In India, the two biggest exchanges are the NSE, National Stock Exchange, and BSE, Bombay Stock Exchange. Globally, the most important ones include the New York Stock Exchange, NYSE, and Nasdaq in the US, the London Stock Exchange, LSE in the UK, and the Tokyo Stock Exchange, TSE in Japan. These exchanges connect companies with investors and play a vital role in the global financial system. Market indicators are tools used to understand the overall direction and health of the stock market. They include price indices like Nifty, Sensex, or S&P 500 that show how groups of stocks are performing. Technical indicators such as moving averages RSI and MACD help traders identify trends and momentum. Economic indicators like GDP growth, inflation, and interest rates also influence market behavior. Together, these indicators guide investors in making better decisions by showing whether the market is strong, weak, or uncertain. Risk and reward market indicators are tools used to understand the overall direction and health of the stock market. They include price indices like Nifty, Sensex, or S&P 500 that show how groups of stocks are performing. Technical indicators such as moving averages, RSI, and MACD help traders identify trends and momentum. Economic indicators like GDP growth, inflation, and interest rates also influence market behavior. Together, these indicators guide investors in making better decisions by showing whether the market is strong, weak, or uncertain. Today's conclusion. Today's conclusion is that the stock market offers great opportunities, but success comes with knowledge, patience, and discipline. By understanding basic concepts, key terms, risks, and strategies, you can make smarter decisions and build long-term wealth. Remember, investing is not about quick profits. It's about preparing for a secure and successful future.